Bank of America just published one of the most extraordinary precious metals forecasts in the history of Wall Street. Their head of metals research, Michael Widmer, projected that silver could reach between $135 and $309 per ounce in 2026. $309 from a current price of approximately $72. That is a potential gain of 329%. From Bank of America, not from a silver newsletter, not from a YouTube channel, not from someone selling coins on the internet, from one of the largest, most powerful, most well-resourced financial institutions on the face of the earth. And almost nobody in the mainstream financial press is taking it seriously. They should be, because on the same week that Bank of America's extraordinary forecast was sitting largely ignored by the media, the world's largest primary silver producer quietly published numbers that make Bank of America look conservative. Fresnillo, the Mexican mining company that produces more primary silver than any other single company on Earth, officially cut its 2026 silver production targets. They revised their guidance down to between 42 and 46.5 million ounces from a previous forecast of 45 to 51 million ounces. The world's biggest silver mine is producing less silver. In the sixth consecutive year of a global silver supply deficit, with a cumulative deficit across recent years that has now reached nearly 820 million ounces, with Bank of America saying the price could hit $309. By the end of this video, you will understand exactly why Bank of America's forecast is not just plausible, it may be the most mathematically grounded, historically validated, data-supported price target in the entire precious metals space. You will understand what the Fresnillo production cut actually means in the context of a structural silver shortage that has been building for 6 consecutive years. And you will understand why the combination of these two stories, told together in context with the full data behind them, represents one of the most compelling cases for silver ownership that has ever been assembled. Let us start with Bank of America, because the $309 target deserves a proper explanation. Not a headline, not a dismissal, but a genuine walk through the reasoning that produced it. The forecast is built on one primary mechanism, the gold-to-silver ratio. The gold-to-silver ratio is exactly what it sounds like. It is the number of ounces of silver required to buy 1 ounce of gold. If gold is at $4,500 per ounce and silver is at $72 per ounce, the ratio is approximately 62.5, meaning it takes 62.5 ounces of silver to buy 1 ounce of gold. This ratio has fluctuated throughout history based on supply and demand, monetary conditions, industrial cycles, and investor sentiment. But it has a long-term historical range, and it has specific extreme points that tell you when one metal is dramatically overpriced or underpriced relative to the other. Here are the key reference points that Bank of America's Michael Widmer used to build his forecast. The 2011 ratio low was approximately 32-1. That was the point where silver had rallied so strongly, reaching $49 per ounce relative to gold, that you needed only 32 ounces of silver to buy 1 ounce of gold. At the 2011 low, the ratio had compressed dramatically from its historical average. Bank of America's $135 silver target is built on the assumption that the gold-to-silver ratio returns to approximately that 2011 low of 32-1. With gold at current levels, around $4,300, a 32-1 ratio produces silver at approximately $134 per ounce. That is the conservative scenario. The $309 target, the extraordinary one, the one that made headlines, is built on the 1980 extreme. In 1980, during the Hunt brothers' attempt to corner the silver market, the gold-to-silver ratio compressed all the way to approximately 14-1. If gold stays at current levels and the ratio compresses to 14-1, which it has done before in history, silver reaches approximately $307 to $309 per ounce. This is not speculation. This is arithmetic applied to historical precedent. And here is what is critical to understand about why Bank of America is producing this forecast right now, in 2026, rather than at some other point in history. The conditions for ratio compression, for silver to dramatically outperform gold and drive the ratio from its current 62 levels down toward 32 or lower, have never been more structurally aligned than they are today. Let us walk through each one. The first condition for silver ratio compression is a bull market in gold. When gold is in a sustained bull market, silver eventually follows, and historically it follows with significantly more explosive percentage gains. Gold went up 66% in 2025. Silver went up 135%. In every precious metals bull market in modern history, silver has ultimately outperformed gold on a percentage basis during the peak phase. The gold bull market is not over. J.P. Morgan has a year-end 2026 target of $6,300 per ounce. Deutsche Bank has a target of $6,000. When gold resumes its march toward those targets, silver will follow, and the ratio will compress. The second condition for silver ratio compression is a structural supply deficit. This is where the story becomes extraordinary, because silver's supply deficit is not a temporary imbalance that can be quickly corrected. It is a structural, deepening, multi-year shortage that is getting worse at the exact moment that demand is accelerating. The Silver Institute confirmed that the cumulative silver deficit across consecutive years has now reached nearly 820 million ounces. 820 million ounces of silver that the world consumed but could not replace from mine supply. 820 million ounces that were taken from above-ground stockpiles, from recycled material, from existing inventories, and are simply gone. Used in solar panels, used in electronics, used in electric vehicles, permanently consumed. And the pipeline for new supply is essentially non-existent on a meaningful timescale. Major silver mines take 7 to 15 years from discovery to production. That is not a typo. 7 to 15 years. No new mine that begins the discovery and permitting process today will produce a single ounce of silver before 2033 at the earliest. The supply problem that exists today cannot be solved by the mining industry responding to higher prices in any time frame that matters for the next several years. The third condition for silver ratio compression is accelerating industrial demand from multiple simultaneous sources. And this is the part of the silver story that most mainstream commentary consistently underestimates. Silver is the finest electrical conductor of all metals, better than copper, better than gold. In applications where electrical conductivity is the primary requirement, which describes an enormous and growing portion of the modern economy, there is no substitute for silver that performs at the same level at a commercially viable price point. Solar panels require a silver paste to collect and transport electricity from photovoltaic cells. Every solar installation on Earth uses silver. Global solar capacity installation is not slowing down. It is accelerating because AI data centers require enormous amounts of electricity, and solar is one of the primary sources of new clean power generation. The AI boom is creating solar demand, and solar demand consumes silver permanently. Electric vehicles require nearly twice as much silver per unit as conventional internal combustion engine vehicles. They use silver in their electrical systems, their battery management systems, their sensors, and their charging infrastructure. Global EV production is scaling toward 40 million units annually by 2030. That is 40 million ounces of silver consumed by electric vehicles alone every year, and that number is growing every year. AI data centers themselves require silver in their server infrastructure, cooling systems, and electrical distribution. Meta just announced 3 major nuclear power deals totaling 6.6 gigawatts of contracted capacity through 2035, specifically to power AI infrastructure. Microsoft, Google, and Amazon are all signing nuclear agreements for the same reason. Nuclear reactor control rods require silver. Every nuclear plant being built to power AI infrastructure creates additional silver demand that most precious metals analysts have barely started to quantify. Goldman Sachs estimates that data center electricity demand could rise 160% by 2030. Every percentage point of that growth creates additional demand for silver across solar panels, electrical infrastructure, and the AI hardware itself. Defense applications, medical technology, semiconductor manufacturing. These are not trivial add-ons to the silver demand story. They are additional structural demand categories that each individually would be sufficient to tighten the silver market. Together, they create a demand picture that is, in the words of trading key analysts, a convergence of forces that makes the current silver rally less a speculative bubble and more a necessary repricing of the metal's role in the system. Now let us talk about Fresnillo. Because this story is the one that should be making front-page news in every precious metals publication on Earth right now, and it is being almost entirely ignored. Fresnillo is the world's largest primary silver producer. Not a silver miner as a secondary product, a primary silver producer, meaning silver is its core business. When Fresnillo cuts production targets, it is the clearest possible signal from the supply side of the market. They revised their 2026 silver production guidance down to between 42 and 46.5 million ounces from a previous forecast of 45 to 51 million ounces. That is a reduction of up to 8.5 million ounces from their previous forecast. From the world's biggest silver mine. In the 6th consecutive year of a global silver supply deficit. Let me put that number in context. The Silver Institute's most recent data showed a structural deficit of approximately 63 to 67 million ounces per year. Fresnillo's production cut represents a meaningful percentage of the annual deficit, widening further. And Fresnillo is just one mine. If the world's largest primary silver producer cannot hit its own production targets, despite silver prices having doubled over the prior year, what does that tell you about the supply situation at every other mine? It tells you that the supply response to higher silver prices is broken. In normal commodity markets, when prices double, producers increase production. They bring marginal mines back online. They accelerate development of new projects. They invest in exploration and expansion. The higher price signal causes supply to respond and eventually rebalances the market. Silver is not responding normally, and the reason is structural. As noted above, the 7 to 15-year lead time to develop a new silver mine means that no investment decision made today, no matter how large, no matter how urgent, can produce new silver supply before the current supply deficit has compounded for nearly another decade. And Fresnillo cutting guidance is not happening because of mismanagement or bad luck. It is happening because the physical reality of silver mining is constrained by geology, permitting, infrastructure, and metallurgy in ways that cannot be accelerated by investor demand or rising prices in the short term. The world needs more silver. The world is consuming more silver than it mines every single year for the 6th consecutive year. The world's largest primary silver producer just announced it will produce less silver than previously expected, and the cumulative deficit has now reached 820 million ounces. Bank of America sees $309. Let us now talk about China, because there is a dimension of the silver supply story that makes everything above even more urgent, and that is also receiving almost no coverage in the mainstream precious metals community. China controls between 60 and 70% of the world's refined silver supply. Not mine production, refined supply. The silver that has been extracted from the earth and processed into the form that industrial users, investors, and mints actually need. China implemented export restrictions on refined silver that are set to remain in place for the next 2 years. When a country that controls 60 to 70% of the world's supply of a critical industrial commodity restricts exports, the supply picture does not just tighten, it fractures. It creates a two-tier global market, where silver available outside China becomes dramatically more scarce and dramatically more expensive than the headline spot price suggests. Earlier this year, ING Think published research confirming that U.S. tariff uncertainty had already pulled significant volumes of physical silver from London to the United States, triggering a historic squeeze in the London silver market, the primary global silver trading hub. Available silver stocks in London declined sharply. Physical premiums, the price above spot that buyers were paying for real metal, stayed elevated even as the paper price was falling. This is what the beginning of a physical silver squeeze looks like. London being drained, physical premiums elevated, China restricting refined supply exports, the world's biggest mine cutting production, an 820 million ounce cumulative deficit, and Bank of America saying $309. Now let me address the question that I know some of you are asking. Is $309 realistic? Or is this just an extreme scenario that Bank of America floated to generate headlines? The honest answer is that $309 requires the gold to silver ratio to compress to 14 to 1, which has happened exactly once in modern history during the 1980 Hunt Brothers extreme. It is not the base case. It is the extreme upside scenario. But here is what matters. Bank of America's conservative target, $135 based on ratio compression to 32 to 1, the 2011 low, is entirely within the bounds of what the current structural forces could produce, without any extreme scenario whatsoever. just a return to the conditions that existed in 2011, not a Hunt Brothers corner, not a once-in-a-century extreme, just a return to where the ratio has been within the last 15 years. With silver at $72, a $135 target represents an 88% gain from $72. In a market with a 6-year structural supply deficit, with the world's biggest primary producer cutting guidance, with China restricting 60 to 70% of refined global supply, with AI, nuclear, solar, EVs, and defense all simultaneously creating new silver demand. With a cumulative deficit of 820 million ounces that cannot be replenished by any investment decision made today. 88% on the conservative scenario, 329% on the extreme scenario, and both scenarios are from Bank of America, not from the bullion rabbi, from the same institution that manages hundreds of billions of dollars in client assets and employs some of the most sophisticated commodity analysts on earth. Let me give you the complete picture one final time. The demand side of the silver market in 2026 is being driven simultaneously by solar energy, electric vehicles, AI data center infrastructure, nuclear power for AI, defense technology, medical equipment, consumer electronics, and investment demand from institutions that have been watching the structural story build for years. The supply side of the silver market in 2026 is being constrained by a 6-year consecutive supply deficit, a 7 to 15-year mine development lead time that prevents supply response, China's export restrictions on 60 to 70% of refined global supply, Fresnillo, the world's biggest primary producer, cutting its production guidance, and a cumulative 820 million ounce deficit that has permanently removed nearly 1 billion ounces of above-ground silver from available supply. The pricing side of the silver market in 2026 is sitting at approximately $72 per ounce, 40% below its all-time high, set just over 2 months ago, in a market with every structural indicator pointing toward dramatically higher prices. Bank of America has done the arithmetic. The arithmetic says $135 at minimum. The arithmetic says $309 at the extreme. The world's biggest silver mine just confirmed that supply is getting tighter, not looser. The data is not complicated. The question is whether you are paying attention while the price is still giving you the opportunity to act. This is the Bullion Rabbi. Stay sharp, stay informed, and protect what is yours.